Good morning. Thank you very much for the introduction. I'm Brian Bartaby. I'd like to introduce you to our company called Proplend. Proplend is an online peer-to-peer lending platform specializing in commercial real estate debt. Over the next 10 minutes, I'd like to try and explain to you the underlying asset class, the brief summary of the peer-to-peer market, the investment opportunity that exists and why it exists, how Proplend delivers on that opportunity, and how you as investors can benefit from that opportunity. Commercial real estate debt is a long-established asset class for institutional investors seeking a reliable and alternative or an attractive source of income with limited capital risk. It's a market dominated by financial institutions and banks. In fact, they account for over 90% of the volume transacted. It's common practice that in larger loans, the loans are syndicated down among smaller investors, each of them taking a small portion of the loan. This allows them to allocate their capital across multiple loans and provides diversification across different property asset classes. What attracts institutions to invest in commercial debt? Senior debt offers an attractive income yield through the commercial FRI lease. It offers transparent cash flows and for known timelines. Loans are secured by way of a first legal charge over the property. Senior debt investors take the least risk in a property transaction as they are the first to be repaid. There is a clear legal framework in the UK, which means that real estate debt offers a low probability of default and high rates of recovery. And research has shown that there's low correlation with equities and provides diversification against other fixed income assets such as corporate bonds or gilts. The benefits of investing in this asset class are as valid for individual investors as they are for institutional investors. But there's a problem. Unless you're a financial institution or a bank or have access to £5 million to invest through a commercial real estate debt fund, this has been a closed market. There's been no access for individual investors being able to gain entry to this marketplace. Proplend has set out to open up this market to individual investors like yourselves. Through our our online platform, Proplend offers investors access to commercial real estate debt market. Investors can circumvent the banks and lend directly to borrowers. It's a process called peer-to-peer lending, marketplace lending, or crowd-based debt investment, loan-based debt investment, Proplend is effectively replicating the institutional loan syndication model for the sub £5 million sector and opening it up to smaller investors. You can invest in it personally or in a tax-efficient manner through your SIP or SAS. Let's take a quick review of the peer-to-peer market in the UK. The market is 10 years old. It started 10 years ago with Zopa, who are a unsecured consumer lending platform. To date, £3.5 billion has been lent across consumer, SME and property-based platforms. In 2015, we've already lent £700 million, which is up 114% on the previous year, and we're expected to hit about £3.5 billion of total loans this year. The government has already have been involved as well. They've directly lent £60 million to SMEs through several online platforms. And in April 2014, the FCA put out new regulatory legislation which all the peer-to-peer platforms have to comply to. Treasury are currently working on a new third ISA called a peer-to-peer lending ISA or LISA. And when this comes in, hopefully in late this year, early next year, depending on the outcome of the election, this will be another tax wrapper which will allow you to invest up to £15,000 in a tax-efficient manner. Although currently termed alternative finance, with a rapid growth in financial technology, the alternative is rapidly becoming mainstream. The unprecedented growth of the peer-to-peer market has been driven by the four different factors. Cash-rich, income-poor investors have struggling to find sources of risk-adjusted fixed income. Bank of England base rates have plummeted 95% from historic levels. These are levels which investors used to rely on for regular sources of income. Customers have lost trust with their banks and are actively looking for alternatives. And there's a surge in the adoption of self-managed online financial services. We started off talking about real estate debt. The opportunity Proplend specialises in lies within £200 billion worth of outstanding commercial real estate debt in the UK. £50 billion, or 25% of this, is loans under £5 million. At the height of the market, there were probably 50 different banks actively lending into this market space. In recent terms, we've come down to a number of about 10. So there's a huge supply and demand issue in this specific area of the market. From working with property investors for the past 13 years, I've seen at first hand this massive funding gap of existing debt build up, which needs to be refinanced, and the opportunity that it offers to savvy investors. So what is the Proplend model, and how can you benefit from it? Investment opportunities are sourced through a network of property investor contacts. We've built that up from the team's combined 60 years of property finance experience. And if we look at an example, so if a borrower owns a commercial property that is valued at £1 million and they want to refinance that, and they're looking to borrow £750,000, 75% loan to value, and they offer to pay 6.5% on an interest-only basis. We conduct our own internal due diligence. We go through a loan assessment process where we look at the borrower, we look at the property, we look at the lease, we look at the level of income, we look at the quality of the tenants. Does the property, should the borrower be allowed to borrow as much as £750,000, and is 6.5 the right rate of interest that they should be paying for that loan? Externally, we instruct valuations from RICS qualified surveyors, and we instruct legals from a certificate of titles on the property to cover the legals. The loan then gets split across 3 loan-to-value based tranches. Proplend was the first platform to implement the loan tranche model, because we understood that not all investors have the same risk parameters and return requirements, but many of them want to participate within the same loan. Each tranche is then allocated a different interest rate, so when combined, blends back to the borrower's pay rate. In this example, tranche A is 5.5%, tranche B is 7.5%, tranche C is 10%. It allows investors to access 3 different price points within the same loan. Risk-averse lenders can lend into tranche A. They can earn 5.5%, and their capital exposure in their investment is limited to 50% of the property's value. Investors who are a greater risk appetite can invest higher up the capital structure, earning 10%, but obviously they're sitting higher up the capital structure. When a loan is repaid in the order of the tranches. So A gets paid first, B gets paid second, C gets paid third. So how do you invest? It's simple, transparent, and secure. You register online as an investor. You can view loan investments. You'll get to see the loan request document that we produce. You get to see copies of the valuation, copies of the legals. You will see who the borrower is, what the property you're lending against is. You fund your account. We hold client money accounts with Barclays, so in client segregated accounts, you put your money into there. And then you invest in individual loans and build up a balanced loan portfolio. Each month, Proplend collects the interest from the borrower and separates it out and pays it back to the respective lenders. And interest can then be taken out as income or can be reinvested back through the platform into different loans. So, as an example, we've put together an illustrative portfolio of some loans that are currently available on the platform. You can see these are going across the 3 different risk bands of tranche A, B, and C, different loan-to-value levels. They're for 3 different types of asset class, of industrial, residential, and retail. And what we haven't put on there is 2 of them are for 3 years, 1 of them is for 2 years. These are loans that have already been drawn down by the borrower, and they're paying interest from the day that you purchase the loan part. So to sort of summarize the benefits for individual investors. It offers investment returns of between 5 to 10% across 3 tranches with regular monthly income. There's capital protection from the underlying security of an income-producing commercial property. You as investors are in control. You invest on a deal-by-deal basis. You have full transparency of the borrower, of the property, and of the tenants. You choose which loan you want to invest into, which tranche you want to invest into, and how much you want to invest for a minimum of £5,000. You can invest either in whole loans or you can invest in alongside other Proplend lenders in the same loan, which is reflective of the way that institutional investors syndicate larger loans. You have the ability to build a diverse, secure loan portfolio, and we also have a Proplend loan exchange, which is our secondary market. This offers liquidity to existing lenders should a lender wish to exit a loan prior to maturity of that loan. It also allows new lenders to come on board and quickly build themselves up a portfolio of income or buying loans that are immediately paying interest. So if there happens to be any cash-rich, income-poor investors amongst you today, then we'd be very happy to talk to you. We're up on stand 58, up on the mezzanine level, and if there's any questions, I'll be very happy to try and answer any questions you may have.